670. You're listening to Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. I'm Justin. I'm here in studio with my trusty sidekick and executive assistant by day, Jennifer Carter.
Good afternoon.
And we welcome you to give us a call, if you like, at 512-643-5483. You can also send us specific questions or comments about the show or about your situation to ask@fortwm.com, and we'd be more than happy to get back to you with a response. We also always welcome you to visit with us at our offices here in Austin, where you have an office located near McNeil and 183, so convenient parking. And you can give us a call at 512-433-6492 to schedule an appointment with myself. If you'd like to sit down with me and ask some questions, have me take a look at your retirement situation, your financial situation, I'd be more than happy to sit with you and give you my opinion, and maybe we could move forward with things that you may need, whether it's an analysis of your situation, if you'd like that done by our investment advisory. I've talked about that before in the past. I think it's very important before I give advice to anybody that I understand fully their situation. And so I'd like to know as much as possible about your situation so that I can give you the best advice possible. And I always promise to be honest and transparent and do those things that I would want to have done to me if I was in your shoes. And so that's how I handle it in the financial planning process there at Fort Wealth Management. So again, you can give us a call at 512-433-6492 if you'd like to pop into the office. We also have a number of books from the past shows we've done. We've got a lot of great authors and guests on that are experts in their field and are quite good at what they do. And I'd be more than happy to give you some literature if you come in the office to visit with me then. Today, we're going to be talking a lot about things that matter always. We want to make sure that you have the information that you need to live the retirement of your dreams. This show is all about health, wealth, and freedom that you need to live life your way, all the way. And, there's a couple of topics that I debate before the show during the week. I kind of wrestle with what is it that we're going to be talking about, because it's so precious the time we have on this station. We get an hour a week, and I want to make sure that I can fill this hour with things that you're going to want to know about. So I really feel strongly that if I can do my job to convey the information that I know that I want you to understand, and you listen carefully, maybe if you've got a pen or pencil by and you want to take some notes, feel free to do that, because I want to kind of rip through some things that are really important, because I know there's a lot of confusion in respect to financial planning. A couple of topics that we're going to talk about today that you're going to want to listen in for. We're going to talk about tax loss harvesting. What is that? What about tax harvesting for capital gains? Can we get a free step up in basis? What about that? What does that mean? Should you be concerned about this? Because, we're coming up on the end of the year, and, like a lot of folks, you go to a CPA or accountant to do your taxes, and what you're basically showing them is what happened. And they have to file your taxes according to what happened. But, it's much better to be proactive with your situation and take control of what you can do today. So we have a couple of months left this year that you can make some decisions that may impact you when it comes tax time, and you're going to want to know what some of those options are. So we're going to talk about tax loss harvesting and harvesting capital gains for a free step in basis. We'll talk a little bit about the stock market. Also, we're going to talk about the fact that there is not going to be a raise on Social Security this coming year. And, that's been a hot topic of the news right now. What does that really mean to you? And what does it mean to those folks that have maybe higher earnings in retirement with respect to Social Security and Medicare premiums? I had a gentleman just recently this week that came in the office, and he was really upset about the fact that he was not aware how some capital gains that he had in some stocks that he had sold off the previous year were going to impact his Medicare Part B premium, as well as some of the other premiums he pays for the drug plans and such. So we'll talk about that. And also, what does it mean to retire in a low return environment? That's the real heart of what I do at Fort Wealth Management. And what you're going to need to understand is how we're going to navigate so that you can live the retirement of your dreams and achieve the income levels that you plan on spending, so you can take those trips and reward those grandkids and all that stuff, spoil them rotten, and not run out of money in a low return environment. We've got volatile stock markets. We've got government that seems to not care about its deficit spending and debt levels, but there's going to become at some point in time some reckoning with respect to a lot of this. We've got low interest rate environment, and when and if interest rates, I say if, when interest rates are going to go up, that's going to impact much of what you're doing and your plans for the future. So we have to be looking at forward-looking models. I talked about this in a past show, and we're going to talk more about it today because we had a little more time today. And also lessons learned. I'm going to start adding this, I think, in the show. I find that in the meetings that I have with clients throughout the week before I have we come on the air, I find that those clients that I'm working with, smart people, hardworking people, they're the kind of people that will sit down with a CFP and have them look at their finances. So these people are more aware than the average bear out there. And still, yet, these people are learning lessons that I believe are material for many of you out there that are important to understand, enough so that I want to spend a little bit of time today on some of the most important lessons that I had some of our clients learn through this week that you're going to want to benefit from. And we're going to go to break here in just a minute. But when we get back, we'll jump right back in with some of those lessons that some clients that we met with learned and what that means to you. And this is, again, The Retirement Journey, Justin Fort. You can call us at 512-643-5483, and we will be back. Retirement Journey, Talk 1370. Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-643-5483. Send us your questions and comments to ask@fortwm.com. And so, lessons learned this week. I had two individuals in my office that learned a similar lesson, and it has to do with fees in their accounts. And these are intelligent people that I had been meeting with, and I'm onboarding as clients. But of course, that process that I told you about, we go through first is an assessment of where they are, and we want to make sure that we are clear as day when it comes to where they are and what they have, because they may have some great stuff, they may not, but I don't know that until I know it, and they don't know it until they know it either. But either way, both of these people were and they're separate people, they came in separate times, were very confident in the fees they were paying, at least at first glance or first question, right? Mm-hmm. I asked them, well, how much are you paying? And they said, well, the first gentleman, he said, I'm pretty sure that I'm paying something like 1.2% and like a wrap fee, he said, for an investment advisory service with a particular firm. I won't name the firm. And I said, well, okay, sure. And this is a problem that I see in our industry. I really think that there's definitely a push towards fiduciary duty, and I'm a believer in that. That's the duty we have at Fort Wealth Management, where your interests are ahead of ours, our clients' interests are ahead of ours. But the problem with fees is that for the most part, much of those fees are not required to be listed on the statements that you're sent. You look at your quarterly statement, mm-hmm. or even in some cases an annual statement, there may be nothing listed except for the statement fee, the $30 fee, annual fee. And that could be misleading. And maybe those folks went through that in the beginning, but over years, some of those fees may have changed, and you may not be aware because really what you're doing is looking at your statements. Mm-hmm. All the information that you need to know about your accounts really is not listed on your statements. That's my firm opinion. And that's because, number one, of fees. And also the statement doesn't necessarily tell you what your risk level is, or, your standard deviations, or some of these other factors that are important to us as financial professionals. But let's just take fees for this case. So this first gentleman came in. He said, I think I'm paying 1.2. I said, well, why don't you go back and you talk to them, and let's just make sure that that's actually the case. So, week goes by, and I had been doing some other work for him, and he comes in, and I said, okay, well, what's the update? He said, well, and he had about $850,000 across a number of accounts, some IRA money, some Roth money, some money in a trust, and some non-qualified money. And he said that these folks told him that he was paying $3,200 a year in fees. I said, wow, okay. It's possible. Okay. I just said, well, which account are they taking from? Because there's a number of accounts here. And he pointed to one account, and that account balance was about $500,000. And he said, they're charging me, they told me 1.2% annual fee, a wrap fee on that account. And on this other one, Justin, they're charging me 1.4% on this money, and that was about $200,000 or so. And then in my trust account here, $136,000 or so, they're not charging me any fees. In my Roth account, they're not charging me any fees, and that's where it's coming from. And I said, that's $3,200 a year. And he just kind of looked at me, and he said, well, he knew he could tell there was something awry there because of my facial expressions, which you can't see. I do a lot. I do a lot of gestures and facial expressions. Yes, you do. Right? Jennifer gets to see them, but you don't. You come visit with me, you'll see it. I'm very animated.
Yes.
It's easy to read me. Okay?
Yes, very
easy to read me. I'm very transparent in many ways, even if I don't want to be.
Right.
And so I said, well, let's just take this first account. 1.2% of $500,000, simply done on a calculator, is $6,000 a year. $6,000 a year is more than $3,200.
Right.
1.4% on that other account added to that. And what about this Roth account and this trust account that they said you're not paying any fees on? What's that? Well, you know what? We can look up, you can do this in your accounts. You can go home, or you're home now probably, or when you get home, break open your statements and go to Google and just type in what is called the ticker symbol. You can do that. Pull up Morningstar. You can type it into the quote search bar there with Morningstar. A website that's pretty helpful with providing information about funds. You can check the prospectus too. There's many ways to do this. You can call the broker dealer. You don't have to just talk to the rep. You can verify these things. And this is some other ways that we do that at Fort Wealth Management. We can help you do it if you like. And again, you just need to give us a call, set up an appointment, and bring those in. I'll do it with you right there in the conference room. And that's exactly what I did with this guy. And it was very enlightening. I pulled up the first ticker symbol I entered. It was for a particular mutual fund. And this is in the account. He said he's not paying any fees. Was 5.7% load on the fund and 1.2% annual fee, maintenance management fee. And he just looked at me and said, "Oh my goodness, I had no idea." So you mean I'm actually paying that? Yeah. Well, how come they don't show that on my statement? Precisely, they don't show it on your statement. So lesson learned. Lesson learned. Your fees aren't shown on your statement. Probably. Some of them may be. And if you're working with an investment advisory, I know that we list them on our quarterlies. I think it's important. I think everybody needs to just know more about what they're doing, and they can more easily shop with other professionals and take a look at what they're doing. And that's what you do when you go to Costco and Sam's and HEB and you're shopping for eggs and milk and other things. You look at prices, and if you don't know what you're paying, how do you know what you're getting? It's a good deal. It's very difficult to know. So that's a lesson. And the second individual, I'm going to talk about here in a second, but if you're just tuning in, I want you to know that you're listening to The Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way all the way. I'm Justin. Again, you can call us live at 512-643-5483 or send us questions and comments to ask@fortwm.com. I'd love you to jump into the conversation if you've had some experience with some miscommunication with respect to your fees in your accounts. give us a call. Or if you have questions about that, how do you go about finding out what you're really paying in fees? And fees aren't necessarily a bad thing. You should just be getting a service for that, right? And to value that service, you just have to know how much you're paying and what kind of service you're getting. It's two sides of the equation. And with this other individual I was working with, same thing. In fact, it was the same. It was the same. And in fact, this situation, she had 1.25. I correct myself. 1.25% RAP fee, which is it's a fee on the total asset level of the account, annualized, right? So they might take a piece of that, a quarter of that every quarter or something. And that's what she believed she was paying. But inside of that account, actually, she had nestled mutual funds. Well, what happens if you're paying a wrap fee, like a wrapper, right? You got this wrapper around this account. And then inside the account, you're also paying fees. Well, that just means that you're paying more fees. That's it. It's pretty simple. And if you've got, in her case, she talked pretty highly about the person that she was working with, for good reasons. But when it really came down to brass tacks, what matters is your money, not how nice they were to you or how they smiled at you. Of course, someone's going to smile with a wide smile and be very nice to you if they're charging you an arm and a leg. They want you to stick around.
Right.
And for her, finding out that she paid a load. A load is a sales charge. It's like an upfront commission. And I'm not saying that's a bad way to go. I mean, I wouldn't do it personally, but I'm not saying that's a bad way to go. I mean, that's the way some professionals get paid. I just think it's bad to not understand what you're paying. That's what the point I'm trying to make. I just think it's bad to pay more than you should also, but you don't know if you're paying more than you should if you don't know how much you're paying, right?
Exactly.
And so with her paying a load there and a maintenance fee, it was like, she really thought she was paying 1.2, pretty competitive, 1.25, pretty competitive. But really it was like in the 2.5 range almost. That's too high for what she was getting. That was her opinion, and that's what she believed because she knew that she can get better deals for money management elsewhere. And I don't want to, jade the whole industry and say everybody's bad and everybody's not being transparent, because there's a lot of good people out there. There are. And, like myself, that want you to understand. We should be compensated as professionals according to what we do. And according to a competitive model, and that's it. So that's enough about lessons learned, but we'll keep those coming. So now I want to switch to the fact that Social Security is not increasing for COLA. And the real crazy thing here is that COLA is supposed to be used by Social Security Administration to adjust the increases with respect to Social Security payments so that people that are living on Social Security alone are not going to be put into the quote-unquote poorhouse and not have enough to live off of in retirement and keep up with the increases. However, the reality is that the decline in inflation really caused by gas prices has caused the COLA to really drop down to about to zero now for this next year. And I've got a piece. This is from CNN Money by Chris Isidore and Katie Labosco. It's entitled "No Raise for $65 Million on Social Security." And you can look it up if you like. This was dated October 15th, 2015. But for the first time in 5 years, there will be no annual raise in Social Security benefits in 2016. And it's because of gas prices, they say. And the reality is that most retirees that are living on Social Security, they're not working, they're not having to drive to work, they're not paying a lot of money in terms of gasoline, right? And that's not a real big factor. What do retirees spend most of their money on? Healthcare expenses, premiums, travel expenses as well, for those trips they want to take. But for the most part, those things increase in price much faster than what COLA would lead us to believe. And so that means that for many, many, many Americans, not receiving a raise from Social Security actually means that they're going to have to reduce their standard of living. And I as much as I don't want to get into trouble with the government, I'm on the radio, I don't want to bash the government, but I think there may be a better way, and probably should be a better way, to determine COLA increases, cost of living increases for retirees than to look just at the simple CPI basket that the government uses, because that's not a great indicator of what seniors spend their money on. Pretty simple. When we get back, gotta go to a break here. When we get back, I want to talk about tax loss harvesting, how you can pay less money to Uncle Sam, pay your fair share, but navigate the system and watch out for those tax landmines that may exist now, today, and in the future for you and your family. We'll be right back. I'm Justin. This is Talk 1370.
Where do we go now? Where do we go now? Where do we go?
This is Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-643-5483 or send us questions and comments to ask@fortwm.com. I'm sure you have an opinion about Social Security not providing a raise and Social Security using a cost of living index or CPI index that doesn't quite relate directly to what retirees face in their spending plans. And so feel free to give us a call and give us your opinion. Let the world hear what you think. Before I get into tax loss harvesting and harvesting capital gains for a free step up in basis and saving you all kinds of potentially money in taxes, which is the best way to save money in my opinion, if possible. I just wanted to round off the Social Security comments I've made and talk a little bit briefly about Medicare Part B and some of the other supplements that can increase based off your income. And I talked briefly about a gentleman that came in and he was talking to me about how he had no idea that his capital gains stock that he'd sold off was going to push him into a position where Medicare was going to, Social Security was going to take more money from him, right? And if you don't have enough money coming from Social Security and your Part B premium goes up beyond what Social Security is paying you, they will send you a bill. And you can check ssa.gov. Go check it out yourself. You can punch it in Google, Medicare premiums increase based off of income. And the kind of income they talk about is really, they call it the modified adjusted gross income, which is pretty much all of your income plus even tax-free type income items like munis. And almost similar to the provisional income that I talk about in my Social Security seminars that I do. We do one of those 2 nights roughly every month or so. Such an important topic. But just real quick here, Part B, this is from socialsecurity.gov. Part B helps pay for your doctor services and outpatient care, and as well as occupational therapy, physical therapy, and home health care. For most beneficiaries, the government pays a substantial portion, about 75% of that, and Part B is paid by the government, and beneficiaries, or you, pay the remaining 25%. And if you're a higher income beneficiary, though, you're going to pay more. And according to the report by the Internal Revenue Service here, you'll pay monthly Part B premiums equal to maybe 35%, 50%, 65%, or even up to 80% of the total cost of the Part B, depending on what you report to the IRS. Why am I talking about this? Because I'm about to talk about tax loss harvesting and tax gain harvesting and taxes in general. And you know by now, if you listen to me for some time or go to my website, I'm not a CPA. I'm not trying to give you legal or tax advice. And please, please, please visit with your tax preparer, tax professional, and financial professional before making any decisions based on anything you hear on this show. There's my disclaimer. But I do want you to be aware of this, because as you navigate and sell off some stocks or lost property or do Roth conversions and things like this, that all sound like a good idea, but you got to put it into a larger context and understand how that could actually impact you as a whole. And just so you know, for married couples with a modified adjusted gross income of $170,000 or less, the 2015 standard premium for Part B is $104.09. If you're above that, for a married couple up to $214,000 of, they call it MAGI or modified adjusted income, then they're going to add an additional $42 a month to that. If you're above that level, up to $320,000 married couple, it's going to be $105, and so on and so forth, up to a total maximum amount of standard premium, which is the $105 plus $230 a month.
Wow.
Each. So that could be $5,000 or so more than you thought, and it could just be 1 year because you reshuffled the deck, your financial portfolio deck, and really that's not the kind of income you're going to have every year. So be careful. Be careful with these things, and you want to have an integrated plan, and that's why I stress again, you got to have a quarterback, and really as a certified financial planner professional, licensed investment advisor, representative, and insurance agent, all the things that I am and that I do there at Fort Wealth Management, I kind of act as try to act as the quarterback for your financial situation. And we need to use tax professionals. We need to use estate planning professionals and attorneys for some things that need to be done for most people. And but putting all that together, just like I've talked in the past about a football team, you can't just have the quarterback alone. You need linemen. You need all the players, the running backs, and the center is important. And all these things, you got to have a good defense as well as an offense. And in retirement, you might want a better defense than the offense. Really, you need to preserve your winning status. I've talked about that in the past, but it's got to be according to a well-laid plan. Let's talk about tax loss harvesting. Basically, if you were unaware, I'm just going to give you some information. This is from boggleheads.org. That's a funny website name, but I just went to boggleheads.org, looked at tax loss harvesting. They have some decent examples here. Encourage you to read it. But I'm just going to hit the high levels here. Basically, tax loss harvesting means that after offsetting realized gains, you can use any remaining tax loss to deduct $3,000 of that from your regular income taxes each year. That's kind of an interesting thing. Mm-hmm. So what's a loss? So let's say you bought a property, some property. When we say property, we mean some kind of an asset. Mm-hmm. Okay, and specifically, I'm going to talk about stocks. So let's say we bought a stock or some kind of a position of stocks that we paid $100,000. And here what they're saying is if we lost, say, $20,000 on that, and we had another position where we gained, say, $10,000. Well, that $20,000 loss will neutralize $10,000 of the gain. Mm-hmm. Okay, but now we still have $10,000 loss. What are we going to do with that $10,000 loss? Well, what the IRS, according to this article here, and the IRS.org, you can check it out yourself, talk to your financial professional. You can take $3,000 of that in that same year and offset your regular income. Well, that might be important for someone that's in a 25% or higher tax bracket, because $3,000, 25% of that is $750 you get to save. You get to not give the IRS. That makes the loss a little bit more palatable. It's kind of like silver lining, in my opinion. Mm-hmm. You don't really want it, right? Mm-hmm. You don't want to spend $1 to save 30 cents.
Right.
That doesn't make a lot of sense. But if it's already going to be the case and it's part of an overall plan, you want to make sure that's the case. And the government lets you take that remaining $7,000 in my example and continue year after year to remove $3,000 from your taxable income. So you can get back $750 basically a year if you were in a 25% tax bracket. But remember, when you sell a lost property, now you are basically locking in a new basis. Mm-hmm. And then, of course, if that property, you reinvest it somewhere else, that property is going to grow. Then you're going to see more capital gains potentially. And it's quite complex. Taxes are complex. But tax loss harvesting, you got to think about it. There may be some positions that you've sold off this year because the market was kind of volatile, right? Definitely on the downside we saw. You may have some tax loss harvesting you want to do. You may want to pair up some of those losses with some gain property. And the only way to do that, and you visit with your CPA about this, is to sell off and realize those gains or realize those losses. Just because your account shows less doesn't mean you get to write that off. Just because the account shows more doesn't mean you owe in every case, right? If you realize, this is a term the IRS likes to use, if you realize a gain, that means you actually sold. So it really happened. Okay, not an unrealized. You've probably seen your portfolios. Sometimes they'll put unrealized there in some of the positions, because what they're giving you is an estimate of what the unrealized gain would be should you decide to realize it. Okay. Super exciting stuff, right? But it matters because this is your money. That's why we're talking about it. And let's talk about the flip side. How can we harvest capital gains? Well, guess what? There is great opportunity, especially for those of you that are going to be leaving an employer, maybe in your late 50s or early 60s, and you're going to have some years there where you may not have a lot of taxable income from earned employment. And what that means is that you can take advantage of some of the capital gain property that has been unrealized thus far. And in those years, when you have low to no income, you can actually not pay any taxes on federal taxes on capital gains. Thank goodness we live in Texas. We don't have to pay state income tax. In some states, there are state taxes, sure. So, obviously, make sure you're aware of your specific situation. But what you can do, and this is actually a piece by Michael Kites, who I think is one of the stellar minds in our world today related to finance. And you can visit this is www.kitces.com. It's a blog. It's entitled "Understanding the Mechanics of the 0% Long-Term Capital Gains Tax Rate: How to Harvest Capital Gains for a Free Step-Up in Basis." I encourage you to read it. If you want to come in the office, I'll give you a copy of this. More than happy to. And even go through it with you and help you understand how this may matter to you and your family according to your situation. What we see here is for lower income individuals, there is a 0% tax rate on long-term gain. You can sell stocks or sell whatever it is that you've got in some cases and not pay any taxes. Well, that doesn't persist forever. What if you sold $500,000? Well, there's going to be some taxes even if you didn't earn any money, right? What most people get confused about, that I find, and you may be confused as well about this, that's why I want to talk about it, is if you've got your tax brackets, you know how that works, like a thermometer, right? You got your tax brackets going from zero if you don't earn anything to for some people, if you don't earn anything, the government actually gives you money. You get a negative tax. You get money back, earned income credits or things. But really, if you're a married couple, you can have taxable income up to $18,150 right now, according to this piece, and pay 10% on that, right? But if you have more income than that, you're going to pay 15% and 25% and so on and so forth. Tax brackets matter to long-term gains as well, and could really in some ways influence, and probably should influence, your decisions about where you have your money, what accounts they're in, and what kind of assets, and when you're going to sell those, and how you're going to harvest this stuff. And capital gains tax rates, according to this piece, will rise. The capital gains rates will rise the larger the capital gain is in the year that you actually go and realize it. I want to go a little more deeply into this, but I have to go to a break. And when we get back, I'll be jumping right back into this piece, understanding the mechanics of the 0% long-term capital gains tax and how you can harvest capital gains for a free step-up in basis and pay the government less. Pay your fair share, but pay less. Avoid taxes. Don't evade them. We'll talk about avoiding taxes and what you can do when we come back from this break. I'm Justin, Retirement Journey Talk 1370. This is Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us at 512-643-5483 or send us your questions and comments to ask@fortwm.com. I wasn't kidding about needing your pencil by, because this is kind of technical stuff, and It's important to understand, though, because you're making financial decisions, and you need to know if you're working with somebody that is talking to you about this stuff or not. And if they're not, then there may be some clue that to you that maybe you need to search around and maybe get a second opinion or a third opinion from someone, maybe myself or maybe someone else. Either way, I want you to know that, this stuff. And, it's important to understand also that I do this radio show. Of course, I get my business name here. Of course, that helps in some respects. But for the most part, this is a way for me to give back to the community that's been so good to me. I love Austin. I wish the best for all of you. And I hope that everybody takes some concern with their financial situation, because you know what? It's completely true. I believe that if a lot of us are making poor financial decisions with respect to our households and for our retirement, and a lot of us end up running out of money, guess what? That's going to be a very negative impact on the rest of us that we're really in other ways well prepared. And the stock market, the interest rates, all these things that we kind of depend on. If we have a large portion of our society ill prepared for retirement and just destitute, relying on Social Security to make up for the gap, in what they need to spend, we could have some rough seas ahead, even for decades to come. And I just want to add a little bit, as much as I can, at least, to the positive side of that. I want to try to reduce that from happening as much as possible. So back to capital gains, how to get a free step up in basis. If you could sell off property, and this is really interesting. And again, this is the article, Understanding the Mechanics of this 0% Long-Term Capital Gains Tax Rate by Michael Kites, How to Harvest Capital Gains for a Free Step Up in Basis. If you could pay 0% in capital gains and just go ahead and sell some property there, some stocks, and then just turn around and rebuy them. You don't have to worry about the wash sale rule when you're talking about locking in a new basis. Basis is like what you bought it for, right? So if you bought it for $100,000 and say it's $173,800 right now, whatever it is, if it's a single stock or a couple stocks, and you have zero income or very low income, you could end up paying nothing in taxes and stepping up the basis on that by selling it and rebuying it. It's really strange, because the $73,800 is the limit where you would pay no taxes on capital gains. Above that, from $73,800 to, for a married couple, $457,600, you pay 15%. Okay. Justin, what if I've got $73,800 income? That's it. So I've the ceiling of the 15% tax bracket, right? What if I sell some long-term capital gains property? Am I going to pay taxes on that? Because I'm really in the 15% tax bracket. Everyone tells me I should pay nothing. Not true. Not true. You're going to pay some capital gains on that more than likely, because that's going to bump you up into the higher tax bracket. The way the government works, they apply ordinary income first to fill the bottom tax brackets first, and then they add long-term capital gains to it. Okay. So let's say we got $73,800, married couple, that's our taxable income, and we go and we sell another, say, $400,000. If we sell another $400,000 of capital gains type property, where there's a capital gain of $400,000, I should say. So maybe it was $1 million and $400,000, you bought it for $600,000, $400,000 is capital gains. That would mean that you have $473,800 of income according to this long-term capital gains chart. And if we subtract the $457,600 limit for 15% tax bracket rate for that capital gains amount, that means that you would have $16,200 taxed at a 20% rate. So the capital gains taxes are graduated. They're graduated. A lot of people don't know that, and that's why I wanted to explain that to you. And so now you know. Now you can tell your friends, hey, I listened to Retirement Journey and I learned something. Capital gains are graduated, so be careful with how much you sell in capital gains a year, and make sure you're wise about using years where you have low to no income to lock in new higher levels of basis for property by just selling and rebuying. That's simple. Talk to your tax preparer about it. And, another thing is, what about Roth conversions and capital gains? Could I have a loss in a property? Let's say I've got $100,000 stock I bought, and that went down $50,000, and I sold it, so I realized I have $50,000 loss. I got no other gain property, nothing else. I'm in the 15% tax bracket, right there, and I want to do some Roth conversions now, right? So you may be able to, with that loss, carry it forward like I talked about earlier. Take $3,000 from it. If you don't have any other property, you can do that. But could you convert $50,000 from your IRA or 401k or something into a Roth account and then say, well, I don't need to pay taxes on that $50,000? The answer is no. The answer is no, because they're completely different taxable type items. The government has these different baskets that they use for different items, like collectibles and paintings and things like that are taxed at a higher capital gains rate for people that are investors in those things versus stocks and other property. And, real estate's even more different and somewhat more complex because of other factors involved. But I want you to know that you might want to have a strategy for Roth conversions, but it's going to depend on how you're harvesting your capital gains and capital losses in other accounts. It's going to be a material factor. And if you're just tuning in, I'm talking about harvesting capital gains, locking in gains, higher basis there so we can pay less in taxes in the future, or harvesting losses moving forward. And this is the Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. I'm Justin. Again, you can give us a call at 512-643-5483 or send us questions and comments to ask@fortwm.com. But really quick, I just want to round this out with one example here, which really gives us a good picture of what I'm talking about. Let's say that you're a married couple, you have $50,000 of ordinary income, and then you recognize a $50,000 long-term capital gain. Okay, so you got $50,000 income, $50,000 long-term capital gain. For a married couple, there could be and should be a personal exemption with standard deductions totaling something like $20,300 if you do the math on it, which means that their ordinary income would be, then your ordinary income would be $50,000 minus $20,300 to reach the taxable income of $29,700. Okay, so now we got taxable income, and that's what matters for tax brackets. Taxable income is not your gross income, okay? $29,700 taxable income, plus now how do we deal with this long-term capital gains of $50,000, right? Well, the capital gains is going to go on top, like I talked about just recently or earlier on the show, where the government fills this up from the bottom, first being income and then capital gains after that. Well, what does this mean for this particular situation? Well, the $11,550 of the capital gains is going to be in a 15% tax bracket. But the first $18,150 would fall, or the income, would fall in the 10% tax bracket. From there, the long-term capital gains kick in, which means that the next $44,100 or $44,100 of the capital gain property, $50,000, is eligible for a 0% long-term capital gains rate. That's good to know. Well, what happens with the remainder? The remainder, $5,900, is going to be taxed at 15%. So, therefore, it could be a good idea in some cases to harvest gain property when your income, taxable income, is low enough. It's been my philosophy for some time that we want to make sure that we're not leaving benefits on the table. And if you don't have a tax strategy for your retirement plan or your financial situation today, you could be leaving a lot of missed opportunities on the table and setting yourself up for future taxes to be quite an enemy to what it is that you want to do come age 70, 75, when you may have much less control over your tax situation, less control than you may have today. Often I find that there's a lot of opportunities for Roth conversions and this kind of capital gains, tax loss harvesting to be done in the in your 50s and 60s, right? Once you hit Social Security where you're at 70 or you're getting your maximum benefits, you're going to be paying taxes on that if you have capital gains and other things. So just know that this is something I'm aware of. And I know it's kind of complicated, but I wanted to throw it out there because I wanted you to learn something today that maybe you may have been confused about. And I've had a number of people confused about this. We're going to go to break. And when we get back, I want to talk about retiring in a low return environment. This is a really important topic. How much money can we draw from your retirement account? How much money are you going to have to be able to spend in retirement based on what you got today? Because we know you know what you've got. We know that you probably don't know how much you can take from it and be comfortable and not be kept up at night wondering if you're spending too much or too little. We're going to talk about that when we get back. Again, this is Justin, Retirement Journey Talk 1370.
And the sun went down as across the hill, and the town lit up, the world got still. I'm learning to fly.
This is Talk 1370. You're listening to Retirement Journey with Justin Fort, and we are back. I want to talk about how retiring in a low return environment, which is what we're facing right now, can be navigated with proper planning and proper information with forward-looking models. Looking at the past, the 1990s happened. But we're looking forward. We've got low interest rates right now. Our interest rates aren't like they were in the 90s. They're not like they were in the 80s. So we are in a new environment again. And we've got volatile markets, maybe even high markets. We may be coming up on the end of a bull run. Nobody knows the timing-wise on these things. But if you are close to retirement or in retirement, like a lot of our clients are, you need to make sure that you're erring on the side of caution, maybe being a little more conservative with your planning, and maybe planning a little more for the worst and hoping for the best than maybe what you've done in the past. Again, average returns in the stock market are fine when you're in the accumulation phase of retirement planning or investing. You're adding to your 401k. You're adding to your assets. You're paying down mortgages. You're doing these things with income you're earning, and you're not so concerned about volatility. Like, for a lot of the people that I meet with, 2000, 2001, 2002 wasn't as much of a problem as 2008 was, because 2008 was much nearer, closer to their retirement date. Mm-hmm. And negative returns, those sequence of returns, we call it, matter more the closer and closer you get to retirement, and it really matter when you're in retirement, because it could set or destroy a retirement plan or trajectory if it's not properly accounted for. And a good analogy, I liken it to a warm bath. Nobody, who doesn't like a warm bath every now and then? You need hot water and cold water, right? And that's fine. That's an average temperature then from the two sides of the faucet, right? Mm-hmm. And the two pipes coming in, super hot, super cold. Well, if we took that out, that's average return, right? The nice warm bath. Okay. Mm-hmm. We take that water out and we put boiling water into one bucket, boiling and freezing cold ice water in another bucket. Now just put your feet in there. Put left foot in the freezing water and right foot in the boiling water. Your left foot's going to freeze, mm-hmm. right? You're going to frostbite on it or something, and your right foot, the flesh is going to be burned off, right? Right. It was the same water. Is the same water, same average returns, and that's why we see in pieces like this piece I've talked about before from Securian Financial. It's entitled "The Importance of When Your Ups and Downs Occur: Points of Interest, Sequence of Return Risk." A couple, two couples they have here earning 6% net returns. They're going to both of them are going to both couples will take 5% annual distributions, adjust for inflation on $500,000 over a 30-year period. How is it that one couple could run out of money at age 78 and the other couple doesn't run out of money? It's because of the sequence of return risk. What's the safe withdrawal rate? How does that work? Well, we turn again to one of my favorite professors, Dr. Wade Pfau. David Blanchett and Michael Fink. David Blanchett is head of retirement research for Morningstar Investment Management in Chicago, Illinois. Michael Fink is a PhD professor in CFP and director of retirement planning at Texas Tech University, Lubbock. And Wade Pfau, one of my favorite gentlemen, we had him on the show before, a professor of retirement income in Bryn Mawr, Pennsylvania. And this piece they did, I've talked about it before, I'll talk about it again, retiring in a low return environment, so important to understand. The 4% rule. If you got $1 million in the past, people are probably still telling you you can take $40,000 from $1 million, adjust it for inflation. You got a 95% chance of success, especially if you have a lot of equities or stocks. Problem is that model, according to this piece, is broken because it's a backwards-looking model. Backwards-looking model that was developed in the 1990s probably isn't going to work for us today, and this piece proves it. If you don't believe it, let's see what piece you've got. I'd like to see. Anyone out there? I don't see anything that refutes this piece. 5% average yields for bonds on the old rule. 12% average equity returns, stock returns. The old rule. The new rule incorporates 2.5% bond yields moving forward, which is more realistic, and a 9% equity return moving forward. And the reality is, as we add equities to this position, this piece tells us that our withdrawal rate actually falls below 3% when we go from 20% equity, 40% equity, 60% equity. The more equities we have, the less we can take from a portfolio with a good probability of success. I'll show you the piece. Come to the office. Call us, 512-433-6492 to schedule a time. Next week, just so you know, there is over $58 billion in missing money just waiting to be collected, and $300 million in forgotten pensions could be reunited with their rightful heirs and owners if you only knew where to look. There is a lot more to locating missing money than just searching your state's unclaimed property website, where forgotten bank accounts, paychecks, refunds, rebates, utility deposits, life insurance policies, stocks, and more wait to be claimed. If a windfall is waiting for you, Mary Pittman, consumer advocate and author of The Little Book of Missing Money, will show you how to claim it. Learn how to claim your missing money this Saturday afternoon at 12:30 on Retirement Journey with me, Justin Fort, right here on Talk 1370. Have a wonderful weekend, and we will see you next week.